Hi, Arno, Paul, Luke. Thanks for being with me. Well, in most of the other panels, we don't allow the speakers to prominently announce themselves, but as you guys all, except for EY maybe, come from boutique, I thought it may make sense if you just very briefly introduce yourselves, what your company is doing, what you are doing there. Don't make it a corporate pitch as we've agreed. Just give the people a little bit of a context. Short and sweet, 30 seconds or a minute or so. Why don't we start with you, Paul? And welcome.
Thank you. It's great to be here. My name is Paul McMahon, one of the co-founders and managing partner of SLM Partners. We are a asset management firm. We focus on sustainable agriculture and forestry, typically investing in real asset strategies and land itself. We manage about $210 million now around the world. We have three strategies, a grass-fed beef cattle fund in Australia. We invest in organic farming in the US via a number of separate accounts. And we raised an Irish forestry fund a few years ago, backed by the European Investment Bank and others. And we're starting to focus more in Europe and put together a new strategy looking at tree crops broadly defined in Europe. And altogether, we manage almost 500,000 hectares of land around the world.
Sweet. And Luke, what about you?
Hi, everyone. Thank you for having me. So I am portfolio manager of our impact strategies at La Financière de l'Échiquier. So we are a French asset manager managing roughly 13 billion euros on both listed equities and bonds. And actually, since 1991, when we were created, we have been working a lot on responsible investment, and since 4 years, diving into impact investing on listed equities.
Thank you. And Arno, last but not least.
I hope so. Yes, thank you for having me. My name is Arno Scheepens. I work for Ernst, as already introduced, at the Climate Change and Sustainability Services Department. And my team and I, we focus on impact measurement and valuation of product, services, companies, and portfolios.
Good. Thank you so much. Well, why don't we kick it off then in terms of content? Just to dive into the discussion, I mean, the title had been, EU Green Recovery and Regulatory Aspects. So let's try to tackle both areas and let's try to combine them where at all possible. But for the maybe non-EU listeners on the call, let's just remind ourselves what the prime policy targets are that we have in front of us here. And then we can talk about how we tackle those as an investment community. Paul, would you mind reminding us of the key EU policy targets that you would love to deliver against?
Yeah, I think as we go through the discussion today, I think it is worthwhile keeping those two things in focus that we'll talk about. One is about doing things in the real world, and the other is actually measuring and reporting on those things. I think what we're going to touch on both sides of that. On that first part of what the EU policy goals are at the moment, I mean, it really all stems from the European Green Deal as the overarching framework. And the goal of that policy is to make Europe the first climate neutral continent. And it really, if you dig into it, involves one of the most radical reorientations of an economy that we've ever seen. There's sub-strategies for energy, for transport, for buildings. Almost every part of the economy is touched. And it's really a set of policy targets and initiatives nested within each other. And if you take, for example, the area we focus on around sustainable food systems, the EU has a farm to fork strategy. Within that is launched just last week an organic action plan, for example, for organic farming. There's also an EU biodiversity strategy, which is seeking to increase conservation of land and biodiversity impacts on forest and agricultural land. And then another climate plan as well. So there's a whole series of plans, initiatives, and targets, which are going to direct investment activity and corporate activity and national policy as well, over the coming decades. And I think that this creates regulation, of course, but also creates a lot of opportunities for investment managers and investors, because radical change is required, capital will be needed, and we see lots of opportunities to invest across asset classes to help deliver those policy goals.
Okay, and this. Thanks for providing the overview. That's a long list, evidently, and you've just mentioned a few. Which out of those you believe would be the prime ones, and which within that then would be the prime goals that you could possibly deliver? And just before you answer, give me 1 second to check here with a technique. Mark, could you give me a bit more volume, please? Thank you. Paul, go ahead.
Yeah, so I think that the area we spend our time thinking about is those strategies around climate and food and forestry. And so we are lucky in a way that we're an asset manager that focuses on real assets. So when we design, develop strategies, we can have some very direct impact on how land is managed, and therefore help deliver those goals. So to take one example, I mentioned the Organic Action Plan. The EU has a target to have at least 25% of agricultural land organic certified by 2050. The number at the moment is 8.5%. So there's a long way to go. So one thing we're seeking to do through our strategies will be to acquire agricultural land, make the transition to organic certification, work with local farmers and operators to do that. So I think, through real asset strategies, whether it's in agriculture, whether it's in forestry or infrastructure, real estate or energy, I think there is a way to directly align with the goals and to help deliver those impacts.
Thank you. There's a clear focus there. So I hear on real asset, and you specifically mentioned climate, forestry, and organic farming. Clearly, this is in the focus these days. We've just heard the announcement that Bill Gates now is the biggest private landowner in the US, isn't he? Looking specifically at how to increase yields out of farmland, but also make it more sustainable. Well, onto the listed equity and the products that we can make available there. Luke, what can you highlight? How do you make this stuff investable?
Yeah, that's a very good question, actually. What happened in the EU since December last year, December 2019, was really massive. So I can see two major impacts. The first one would be, how do we invest as investor as a whole, actually, not only impacting investor myself, but investors as a whole. We will have major impact on the fact that we will need more transparency, better reporting, maybe start some impact measurement, and this has been raised by SFDR. So this regulation that we need to put our funds on listed equities, maybe on one of those big three articles, Article 6, 8, 9. So where do we sit? Are we more impact, more responsible, or just using ESG as a basis of investment? So it will really have a clear impact on how do we invest. And also where we invest will really change. I think that the announcement of the EU Green Deal actually is really changing a lot what we're seeing for companies in some specific sectors, actually, which are the ones that we've seen a large inflation of valuations, like renewables, insulation, energy efficiency. On both sides, you have an increase, a massive increase in business upside, possible upside and addressable market. On the other side, you have those valuation increasing, so some maybe risk on bubbles, but I can come back on that later. And on the top of that, really, what is really important, I think, is that we will flow capital to more impactful companies. So the environmental, climate, social impact will be increasing gradually through those regulations, because it is not just about reporting passive, but really engaging, flow capital through specific sectors and companies that drive positive impact. So pretty much aligned, what I do, which is very good news, actually.
So changing what we do and where we invest, but also how we invest, does it really shift the needle? Well, in order to answer that, we have to know whether this change is real and is for real and does hit the real economy, as Paul has rightly emphasized. So we need to look into what we're doing and assess that. For that, we need reporting, and we need to assess the impact. It seems to me, Arno, you are an expert in that. Where do we stand?
Well, that is again a very good question. We stand at, I think, the beginning of a transformation where there will be more transparency coming from the companies themselves, because they will effectively have to, following the SFDR and EU taxonomy. So what we see from day to day is a steady increase in requests for detailed impact measurement on product level, on company level, and increasingly also on portfolio level, and then not just top down, using data providers, ESG data providers, for example, but also bottom up, and really developing an understanding of the actual measurable and quantifiable impacts, positive and negative, not only by the companies themselves and reported by the companies themselves, but also for people outside of those companies in this value chain.
Let's just dissect those two things. So you're getting the reporting by the asset management firms, and evidently the asset management firms being fed for the reporting by companies and others. How robust are things presently, Arno? How much confidence can we have in those two sides of the coin of reporting?
Well, as an LCA practitioner, I always have to answer, it depends. There's obviously front runners in this, and there's laggards. There's a wild difference in granularity of information being made available. But on the upside, there are huge movements going on also from the European Commission in, for example, life cycle assessment, where the product environmental footprint project is really trying to limit the amount of maneuverability, so to say, within impact measurement and reporting, to ensure a single green market, as the EU is calling it, where results being reported and published are actually comparable and benchmarkable within their product categories or company category.
Do you, to Paul and Luke, do you get the information you need in order to report back to your constituents in turn? Whoever wants to go first. Paul?
Well, yeah, our situation is slightly different, that we don't invest in companies that we then ask to provide information to us. We invest in assets themselves, and so we have to create that data and that information flow ourselves. And I will say that, one thing we have seen is there's a bit of a tension, I think, because there's a desire to have common metrics and frameworks, across multiple investments, but also even sectors, which can be kind of rolled up and compared and give aggregated, let's say, results. But actually, we're finding sometimes then you lose some of that granularity and the specificity of what's actually happening on the ground, and we've found that we've had to develop, while we try and incorporate into some of the global frameworks like SDGs, we use the Global Impact Investing Network, IRIS, plus metrics, consistent EU taxonomy. We actually have developed our own property level, assessments, which we need to track what's actually happening. So, for example, if part of our strategy in Ireland is to take forests, which were managed using a clearfelt system, to something called continuous cover forestry, there's a set of indicators around that, around species composition, biodiversity, at technical level, which is never going to be captured in the high level framework. So we need to capture information at the asset level. And then is a way, how do we then flow that back up? But let's not lose the granularity at the lower level, while doing it, because it's at the lower level that we can really validate and demonstrate that theory of change and, the actual thesis which is driving the strategy.
So, on the one hand, you're an awful lot closer to those real assets. On the other hand, I would argue maybe there's much less guidance, isn't it? I mean, most of the big frameworks, be it SFDR directed at bigger asset managers, being the non-financial reporting directive being directed at bigger companies, it's all for the bigger companies. Do you get any guidance there at all then, Paul?
I think, again, I think the frameworks provide a common language, a set of categories which are helpful. I think there's been, and if you look at the different initiatives, there's probably been more work done on things like energy, in particular, infrastructure. If you look at agriculture, forestry, there's a lot of, to be determined. You watch this space. I think that we are expecting to see more detailed regulations and guidance coming out as the end of this year from the European Commission on how to apply some of the things in our sector. So I think it is coming, and it is getting a little bit better. I think one thing that we found is, is, as I think what we're doing is quite specific, is the importance of also relying on third-party validation for this. It's quite easy for a manager to, not say massage the numbers, but to kind of cherry pick and present information in certain ways. And maybe, having a third-party validation is going to be more and more critical as you go forward. And that can happen through certification programs. It can happen through life cycle analysis, as we heard. And so one thing we're exploring is actually partnering with specialist third-party companies who can provide that service to us as a manager. There's a cost to that, so everyone has to be very aware of that. The managers, the investors, that always becomes a fund cost, impact measurement in itself, and it's going to budget it for, and everyone understands, what they're going to get from that.
So, I mean, let's turn to the bigger companies in listed equities with Luke in a sec. I just want to turn to one of the auditors that you have mentioned, Paul, evidently is EY. So my question to Arno is, if I'm an investor in such solutions that Paul provides, or in other solutions, more the listed type of things, what is better? Is it better to stick with the bigger companies and listed stuff where I have clear frameworks available already, or to sit closer to the assets with Paul? And, there's maybe less guidance, but I'm close to the asset and real economy change. Or is it two entirely different worlds and it does make no sense comparing? Just help us out a little, Arno.
To answer directly, I think it's a bit of both. I think it's impossible to have an asset level focus on broad portfolios on every single asset that you have. So I think what is needed is some sort of pre-filter which directs you towards those group of asset, or maybe the single asset that is responsible for a high environmental impact and perhaps low market value or economic metrics, to put those environmental metrics into perspective. Because a car has a high impact and a teaspoon doesn't, if you look at it from an absolute sense, but you need to make sense of those numbers compared to the value that these products, that these assets may deliver. How they contextualize, so to say. And actually, we are involved in projects where we try to standardize true cost accounting for the agri-food, which is basically an IT mechanism to derive farm-level data for big agri-food companies in Europe from their actual supplying farms, and having those impact data from each farm aggregated to the total corporate level. Not only allowing companies to show their sustainable choices in their supply chain, basically, which in agri-food biggest material impact is in the food production, the farms and the land use, all those kind of indicators. And also to innovate your supply chains further and to really engage with the suppliers showing a relatively high impact or very low impact, and finding out as a company in this sense, but also investors in those companies, and how they are performing and how robust they are in their ability to create long-term value. So that answers the question.
In your remarks, we already hear, Arno, that in the case of bigger companies, you are so much further away from the real economy change, evidently. You're talking about companies having supply chains. We could also think of companies making capital expenditures, and those then are the assets. But you're always a step away from that, aren't you, Luke? So in your case, how do you get the information from those companies so you can report impact back to your constituencies? I mean, on the one hand, there's more guidance. On the other, maybe it's too stringent or too granular or not granular enough. How does it work for you as a practitioner?
Yeah, that's perfectly exact. I mean, we, on one hand, we have that huge pressure, which is positive in my opinion, on more transparency and impact measures for the company we invest. And today we do not have the data actually, and we need the data from the company, from the companies. So I would say that we have two tools. The first one is to engage with the companies. Actually, in 1 year or 2 years, they will have to report the data from, we talked about the EU taxonomy, so the green revenues they have, for instance, they will have to report on that. So I'm not that, I'm very confident on the fact that the companies will provide the information there. But we need to engage and try to have the information a bit faster, or good granularity or good quality of the information they will give to us. And on the other hand, we do a dual job. I mean, internally, we will try to assess ourselves the impact, the information, the data from the companies, and maybe work also with external data provider that will complete actually the gap that we have. So, multiple tools to really have this ability to assess the impact. And, to my opinion, and I think this is very wise what Paul said on the third-party validation. This is what we do also on the listed equity. This is very important. And I think that we will see a major impact from companies, because when you start to have all those investments and this reality facing by listed equities, those companies have a systemic impact, right? So when they try to change their supply chain, their value chain, their product, the impact of their product, the impact on the society is massive. So we need both those, private equity, real assets, and listed equities to work towards the UN SDGs, which is what we aim as well. So I think all these evolutions in the EU we're seeing, and I'm sure that this will spread in other different regions of the world. This is really a catalyst to drive more impact, and of course, and this is my my conviction, some financial performance as well.
Well, but what I have heard is that sometimes you have to make assumptions, as you've just said. Engage with the company, see whether you get other data, get it earlier. If you don't get it, fill it in yourselves. Arno, I mean, you see things at a bigger scale, evidently, because you see, you don't just see Luke, you see others doing the same exercises. How robust is the whole reporting we're getting then? And on the back of that, the impact we can estimate that is there on the real economy. If everyone's making assumption upon assumption.
Yeah, assumptions are necessary evil of the trade that we are in, because it is a utopia that the modeling that we do to assess environmental impacts, for example, is one-on-one relating to the truth. It's a modeling exercise. And as soon as something becomes a modeling exercise, you have to make assumptions for data gaps, which means that there is a certain uncertainty inherent to the results that you're getting. But also here, there's, I think, two sides to the coin. I think for reporting, it is imperative also for getting the assurance that is being talked about, that the standard for reporting is universal and comprehensive enough, but also practicable by companies to apply to, right? So they need to not be overburdened with too detailed prescriptions of how to report their non-financial performance information. On the other hand, it needs to be detailed enough to reflect the real change that is supposed to be happening on the ground. And that's I think a story we will never completely fix. We will never completely fix that problem. But as soon as we have the standard agreed upon by a large enough group of institutional investors, for example, then it will start to make the change in the sense that it's not about the absolute numbers, but about the comparative numbers. How effective is an investee in reducing their negative impact and increasing their market value, for example, at the same time. The other side of the coin is, I think, the innovation part and also the intelligence part on the asset managers part. So the reporting of the information is one thing, but interpreting that information is another thing, right? As long as it's universally reported, then you can put things next to each other. but it's only a snapshot of a limited amount of data transformed into an impact picture. But in order to contextualize that picture, you need to have your own idea about, okay, do I think that a different valuation, for example, is in place? Do I think that carbon is being mitigated more swiftly than perhaps the projections think now? So do I need to perhaps look further than this particular investment, which has a carbon reduction potential, but has an increase, for example, in fine estimation? I hope that sort of answers the question.
I
but
think
it's a really,
that
really
was a
good
call.
one.
That was a call to you, Paul and Luke, how you're interpreting those things and whether you are providing the context that Arno just told us is so important. Are you guys? Paul first.
Yeah.
I think.
Sorry, go ahead, Paul.
Yeah, just jump in. It's an interesting point about also the role of models and again realities on the ground. Like I think, models are necessary, but they can also be straitjackets as well. They can be backward looking based on, let's say, how things used to be done, and can sometimes be maybe constraining innovation. That's why I think it's so important to always kind of ground truth data as well. So again, to take a farming example, you may have certain farm level models which try to predict what's happening in soils, there's a soil carbon, or based on certain farming practices, but actually there might be innovations you can use to actually improve those results. So it's still important to take soil samples and measure the actual amount of carbon in the soils, so you can kind of calibrate and improve and refine the models as time goes by. I think that's one important point to make. I think another thing, and one thing which could change and bring more robustness to some of the data collection, especially around carbon and climate change, would be further evolution of carbon credits and carbon markets. It's something we've seen in Australia with our fund there. The Australian launched something called the Carbon Farming Initiative. A few years ago, they put over $2 billion Australian dollars to work to pay farmers and landowners to store carbon. That then catalyzed a whole ecosystem of project developers, of technologies, of methodologies, around carbon storage on land. And we participated in projects to generate and sell credits down there, as of many others. And so there's a level of robustness and verification because it's a Kyoto compliant carbon credit scheme, which you're never going to get if it's just kind of voluntary, in-house manager reporting. So I think the more we see these things like that, carbon credits, robust, verified, let's say, methodologies, the more we're going to see that extra level of rigor come into the data collection reporting back from the ground level.
That was a great example. Hands-on, I like that. Thanks so much. Luke, I see you're not there. You want to come in?
Yeah. I think I completely agree with Paul. We need to, models are not the entire solution. We need to go to the ground and see exactly what are behind the each impact measures and how we can drive it through, in my space of listed equity, through the investment process and the investment case of the companies we just give them capital. So there is examples of companies, just having renewable energy producers. I think that 100% is green revenue, right? But impact could be a bit beyond that. And all the work that we are doing is really to see, is that the renewable energy that they are putting into the network is on specific, underserved countries, or they really work into biodiversity without, having too much space on the ground, on the lands. So there is those big numbers that we use, and behind that, we need to dig a little bit and make sure that there is no negative impact, or that there is co-benefits from what we are looking at. So, go a bit beyond just the, the CO2 carbon footprint, for instance, or those big numbers we have, to make sure that we understand the companies and their impact. So I think this is the idea of the EU at the end, is that we just have a framework we can understand and work on what is measured. Actually, this is really the idea. But once you have a measurement, try to go a bit beyond and look at exact impacts.
Do we have those tools, Arno? Really?
Yes, we do have them.
Tell us more.
Although, well, I already mentioned it. I think. Well, I think in terms of company assessment, not so much, but in terms of product assessment, there is life cycle assessment which has been developing over the last 70 years. Vast databases behind it, really developed methodology, and is quite robust, I have to say. Of course, a bit biased as a practitioner, but it's getting there, and with the developments and the projects going on, it's going there. And what life cycle assessment basically does is look at the complete value chain of a product and a service, and quantifies the environmental impacts associated with raw materials extraction, transportation, production, assembly, distribution, use, end of life. And it quantifies the environmental impacts into up to 19 different environmental impact categories, of which climate change is but one. So some examples of other ones is acidification, eutrophication, radiation, human toxicity, ecotoxicity, land use, all these kinds of things. The big one missing, by the way, is the biodiversity one, which is connected to land use, but not only land use. It's also about land transformation, right? Because organic farming or agroforestry can be quite biodiverse, but it's still arguably less biodiverse if humanity wouldn't be there in the first place, right? So that one is very difficult to quantify because the value of natural capital or the prevention costs of not removing natural capital is a big gap in the current methodologies. But also that one, you is really working hard on it with for example, the Business at Biodiversity platform, really working on EU tenders for developing biodiversity metrics, which can be integrated into these types of systems. What else he also provides is then an aggregation of these different environmental impacts into a single indicator for life cycle assessment, which is necessary if you want to have a sensible comparison between two different products with two different profiles across these impact categories that I just mentioned, right? So how do you decide which investee is more sustainable on a product level, company level? If the one has a higher carbon footprint but a lower fine dust emission, for example. So what LCA provides is also a monetization methodology, of which two are scientifically published, and then one is captured in ISO standard 14008, which allows for monetization of the environmental impacts through different methodologies. The other one is, for example, eco-cost, which monetizes environmental impact according to the prevention costs needed to avoid the impact in the first place, below the carrying capacity of the Earth threshold, so to say. So from a modeling and theoretical perspective, if you are at zero eco costs, you are net zero. Well, not net zero in carbon. We're still allowed to emit a little bit of carbon per euro spent on the market, but it's significantly less than what is being done right now.
Let me just, thanks for this. This was a great rundown. Let me just check that again with the practitioners. I saw both gentlemen nod vehemently when you explained how it works. Does either of you use any of those tools Arno has just described? Give me your views.
Yeah, essentially, we're going through the effort now to integrate that kind of full life cycle assessment as our next European strategy. I think we do see the merits of being able to look at land in this more holistic way, and both from the inputs used on the land, whether that's fertilizers or water, diesel, machine operations, but also the operations themselves and what's happening in soils with trees, and emissions and also carbon storage around it. So one of the goals we have, our next strategy will be to be a carbon positive, climate positive portfolio where it's storing more carbon than it emits. And the only way to be able to kind of prove and back up that claim is by doing that kind of life cycle analysis. And I think it's essential as well to have a third party really coming in and doing it with us, or else it's not fully credible. So I think what Arno says makes absolute sense when you get down to sort of the granularity of different products or different kind of land use systems.
And Luc, what about you?
Yeah, I wanted to bounce back on what Arno said on biodiversity. I completely agree. This is something that is, for listed equity side, really missing. And the only solution I have today as data is impossible to have from companies, is really to engage and ask questions. And every time we meet management, we say this is one of our top priority, and we try to set up some targets to improve, to have their transparency on their supply chain for the agribusiness. So this is quite different as Paul, because we are far from actually the concrete reality on lands and agriculture. But for the part of our holdings that we have on this sector, we are just here to engage, and actually the impact is we see the impact from the policies of the company, but it's taking much time. So yeah, I think this is one of the objectives we have through engagement when measurement is not available. And of course, we ask our companies to do some LCAs of their products, etc. So we are not in. When we are not in real asset, we cannot do all those assessments ourselves, but we ask the companies to do, and the pressure on them is quite important to have results at the end.
Fair enough. And
just to
yes,
jump in there, because I think that's a really important point, that even with the world's best models, with life cycle analysis, we're never going to be able to boil this all down to a single number. That it doesn't remove the need for investors and managers to do their own due diligence. It happens at every level. As investors doing due diligence and pushing managers, then managers doing due diligence and pushing their investees. At each level needs to be kind of interrogated and checked. It's never going to be a robotic, I think, system where the machine spits out an answer. It'll always take the same level of rigor and due diligence that you would get on the financial performance, we need to put into the environmental performance. And
let's test all that we have just discussed, including these critical comments that you've just made, Paul, against the social side of things as well. I'm conscious of time. I think, let's not get hooked up too much with the environmental side of things, as important as it may be. And I agree with you that hopefully biodiversity will specifically rise up the agenda. Let's hope in the wake of COP15 at the end of the year, just prior to COP26, we may see biodiversity become as important as the climate crisis. Personally, I very much hope so. I think it's a biggie, and it's being omitted too much. But let's turn to social issues. If you look at things with a wider social lens, or with a wider development agenda, even keeping in mind the SDGs, how does all that we have just discussed look then? Do we have the right tools at our disposal? Can we measure things accurately? Are they being reported the right way? Do we have the harmonization and the tools available? Can you give us a bit of a sketch there, maybe, Arno, to kick us off on the social side of things? Or SDG, however you want to take it.
No SDGs for me, no. The short answer is not yet. There is many different frameworks, such as the UNEP guidance on social life cycle assessment, for example, which helps in framing the quantification of social impacts. But until now, those type of like assessments, let's call them like that, have remained foremost qualitative, right? So we see that there's certain social incentives being taken. There's a lot of focus on training of personnel, operational health and safety. What we see too little of, and it's starting to become more relevant, is more human rights in supply chains, so social impacts associated with workers, for example, in agriculture, seasonal workers, forestry, in working in poor conditions, making excessive working hours. I don't think I need to explain the clothes industry and the huge social issues in those supply chains that frequently pass the news, at least here in the Netherlands. What I would like to add is that the biggest caveat in that for us as impact measurement professionals is that there's no databases being developed yet as much as has been done for environmental impact. Right? If I need to look at for the environmental impact of a kilogram of steel, I can look into a database and I have an average profile of what types of emissions and impacts are associated with production, use, and end of life of that material in any product. What I cannot access right now is a database which tells me how many worker hours have been put into that product, under what conditions, in what country, and against what pay, to name a few of the social impact indicators that we think are very important and still not included in quantifications as far as we're extensively.
So we need that social life cycle assessment as well. It seems in the beginning you've said, Arno, no SDGs for me. Is that because the challenges are then even much bigger than what we've just described because you're broadening out wider, or why is that?
Well, I'm just not I think a goal is fine, but I need I as a person I need a number to that goal in order to be able to measure how far we've progressed against it.
Yeah.
And no poverty is of course an important goal, but what does that actually mean in terms of payments for workers in which country? I don't have that answer based on the SDGs, so that's why I jokingly responded no SDGs for me, because I cannot really work with them until they are really quantified and specific to
But what if you drill down?
global.
What if you drill down to sub-indicator level? Then is that still not tangible enough?
It is by far the best target setting that I've seen holistically. But I think that specific targets for carbon differ per sector, because the need for the products and services that certain sectors provide is still there. You can say, okay, there's a carbon target of, I don't know, X amount of carbon emissions on a country level. But on a specific product or a company, that doesn't mean too much to me.
Okay, fair enough. So how do you manage then, Paul, Luc?
I think that the social impacts are actually very, very difficult to grapple with. I mean, if you look at the EU Green Deal, which is an environmental policy, the third pillar of that is no person, no place is left behind. So it is there as well. But again, in a very vague, almost a generic SDG-like way. And it's not always clear, even if you have a number, like what's a good number, what's a bad number. So if I say one of the numbers often measured is full-time equivalents, number of full-time equivalents. But is it better to have 100 FTEs, poorly paid, low-skilled workers, or 20 FTEs, highly skilled, well-paid, supported by appropriate machinery? Neither one nor the other is good or bad. I mean, it's all about the context. So I actually think that there's a real limitation of what we can do around social impact. I think one advantage of working in the European Union, given the high standards of labor laws and social protections, is we don't have maybe quite the same problems to worry about as in more developing countries and some of the, let's say, supply chain issues that Arno was referring to there. I think one area we do think a lot about is maybe that geographic aspect, about no place left behind. And I think that there is a general trend where most investment going into urban areas, economic growth concentrated in urban areas, and rural areas being left behind, and problems of land abandonment, aging population in those rural areas. So we do think there's a positive role to be played by just bringing more investment into agriculture forestry systems in those parts of Europe, which can sometimes feel like they're being left behind.
And is that enough? I mean, we got a question from the audience as well saying, well, we've got an awful lot of regulation coming out of Brussels these days focused on environment and on climate specifically, much of that regulation interconnected, but then again focused on environment. You're right, Paul, this is the EU, but still evidently the guidance has global repercussions if, investment managers want to sell in the product or market as sustainable in the EU, or if you have operations in the EU or headquarters. So it has global ramifications. So the question from the audience was, would we then need something like a social taxonomy, just like we have a green taxonomy? Would we need like a social deal like we have a green deal? What's your views on that? Luc, I see you nod there.
Yeah, that was exactly what I wanted to add, is that I'm just waiting for the social taxonomy, because today, as Paul mentioned, I completely agree. This is just, a do not harm principle, actually. So we want to have good environmental climate impact without harming too much the social side, but this is not, specific at all. So I think the EU is working today on a social taxonomy that will give very, very specific data and targets and objectives. But this is difficult because this is human beings at the end. So to me, it's always difficult to put numbers on on social matters. And well-being, for instance. But anyway, I think we will really see this social taxonomy. But the fact that there is no that much social information, impact, regulation today does not mean that we should not care at all. So, and I think this is all the idea of responsible investing on my side in listed equity. So we need to have responsible companies to invest in, even if they have positive environmental climate impact. We cannot have those positive impact if on the other side you have a negative impact on social matters, for instance. So all this idea of net impact, net positive impact, and this is where we work for on listed assets, is that you can have positive environmental if you have negative on social. This will not work. So always be conscious on the different impacts that could drive from your investment from the products, and of course waiting for the social taxonomy. But I really don't know how they will be any guidance there from the EU, but I think they started to work on the social taxonomy.
Yeah, we will have to see. It seems like they're first trying to finalize the green and then add a grayish one to it, isn't it? And maybe then go to a social one. But you're perfectly right. Net zero doesn't deliver much if it's net zero on the environmental side with very big negatives on the social side, is it? Although it makes our lives even more complicated. I would love to turn to the other side of the coin now, which is those who invest in your products, Paul and Luc. We've talked an awful lot, evidently, about do you get the data that you need to get about what companies or your assets are doing and how they're faring in terms of ESG and with a particular focus on E. We've also discussed, what is the real, can you assess the real world impact from that? Now, I'd be keen to hear from you how those that invest in the solutions that you offer, the solutions to make the EU Green Deal investable, if you so will, what is the feedback you're getting from those asset owners on you trying to elicit that data, you trying to assess that real world impact with all the caveats that we have discussed and the shortcomings that Arno has raised? What feedback do you get? Luc, why don't you kick us off?
Yeah, sure. That's not an easy question because the feedbacks are multiples. I think first, this is very important and good to start working for impact. Means that even if everything is not perfect, we do not have the exact perfect data on environmental and social. We need to start, and I think this is the strength of engagement. And what I have from feedbacks from asset owners is that they know that data is not perfect and companies are not giving us enough information, but just being an active shareholder is part of the solution, because if you're just passive, you buy from the secondary market on listed equities actually, but you buy a stock and then you just wait for returns to come. You're losing the most important side of your impact. So we need to be active shareholders on listed equity. This is surely different from Paul's perspective on real asset, but we really need to be active. And just the signal of talking to a CEO and saying, we look for the impact of the products, etc. This is driving major changes, and I'm seeing it. It could be greenwashing sometimes because many companies now are trying to, improve their communication on green and social impacts, of course. But this movement, to me, it's a tsunami actually, as you have, even if some companies are doing it really for impact, this is fine for now. So this regulation, these signals driven by the EU and all the investors that need to align is not neutral at all. So we're seeing that, and I think the asset owners as well are seeing that, and they want to flow their capital through investors that are really active and try to push things. And we can do this also not alone, but with other investors, and we regroup. This is the collaborative engagement. For once, we're not competitors with other asset managers. So yeah, this is really an action, proactive action that works beyond all the caveats we talked about, of course.
Well, how easy or how hard then is it to satisfy the asset owners? I mean, when you're describing all the challenges in getting data in the first place from the companies you're investing in, or getting robust and credible data, do they let you off the hook reasonably easily, saying, okay, you do a couple of engagements, talk to those companies, you're okay, or do they really press you very, very hard?
No, I mean, we cannot just say things and say, yeah, we're engaging, full stop. No, we have a very strong impact reports, very strong reportings that we provide to them. This is really qualitative, actually, just saying that we have done that number of calls with each company. We have done that kind of, engagement on climate change. We ask them to have a full policy. I have many examples, but I think their insurance here is really the reporting that we provide to them. And all this regulation we talked about in EU does not ask for that detailed reporting on engagement, for instance. So this is something that impact investors go beyond. So we have a clear annual, regular, qualitative reporting, and this is quite a good tool for asset owners. They don't just, sign the check without proof. So this is the right proof of examples, concrete examples, name the company, say what you've done with the company, and at the end measure the impact that you had, saying that we asked that 2 years later, we've seen the results. So this is what they need, of course.
How much heat do you feel in your business, Paul?
Yeah, I'd say investors fall into probably three camps. I think the first, there are those investors who are, let's call them impact motivated investors, who are highly engaged, who often have quite a lot of technical expertise in-house, and who will absolutely engage with a manager like us, even pre-investment, to help almost design together, the impact measurement system. We've had that experience with a family office in the US who really cared about water impacts, for example. So when they came to making investments in cropland in the US Midwest and converting to organic certification, they wanted to know that that conversion was going to have a positive impact on reducing the flow of nutrients into waterways, for example. So we sat together and we developed the system for that. Similarly, when we put together a forestry fund in Ireland, the European Investment Bank were highly engaged. They have teams of foresters, environmental experts. We sat with them, developed a set of indicators that we would use to measure impact in those forests in Ireland. So they're quite technical, very engaged processes at an early stage. I say the second camp, though, are investors who don't really care. It's still about the financial returns. And that group, I think, is shrinking over time. The third, I'd say, are those who do have now some kind of a mandate and a need to report back and impact themselves. Sometimes it's coming from on high, it's coming from the CEO, it's coming from the board, it's because they signed up certain commitments under net zero or biodiversity or something else. So and it trickles down to portfolio managers, in the end investors, who then have a need almost to feed that machine themselves. And so I think for them, it's being able to provide quite simple solutions almost, it's sort of a data reporting package, hopefully align with some of those common frameworks we talked about earlier, that they can use and then plug into their systems, And I think that third category is probably the largest and probably growing. And in particular, I think finally probably a geographic, dimension as well. Within Europe, almost all investors in one of those first and third camps. There aren't too many now in that second camp who just don't care. I think the rest of the world, there still are a few and more in that second camp, but I think we're starting to see more interest and engagement in other parts as well, as people understand that the need to to measure important impact.
That's good to hear, and thank you so much for providing me with a balance between those three camps. That would have been my follow-up question, but this was good to hear. We are really seeing evolution there. I think we were just onto something here, but I'm afraid, conscious of time, we may have to go to the wrap-up pretty fast. And those, well, we haven't had the pleasure before, but I'm known for always asking this one question in the end, which is, please give us a short and sweet summary of what you would love to convey to the audience. Just imagine someone is just dialing in now and hadn't had the pleasure to listen to our deliberations, and you still want to bring across that one or two or maybe three things that you would love them to remember from your interventions. What would that be? Let me start with Luke.
Yeah, sure. I think impact investing in listed equities is a part of the solution for our future world. I think impact investors are not naive at all. We know that there is negative impact. We know that we cannot, drive all the impact through big listed equity companies, but we have the power to change because, being shareholders give you great power, actually. So when you engage with the company and you push them to increase their impact, this is where you have the most impact, again, I would say. And I really, convey the audience to invest in listed equity. So on European impact, which I think is really driving both positive social and environmental aspects and financial performance as well, which is not cannibalizing each one or another.
That was a bit of a sales pitch, but that's okay. Arno, you go next. Make it short and sweet, please.
All right. My takeaway or my summary is that increasingly bottom-up impact measurement and valuation will become more important to enable and substantiate impact investing. So I would urge investors and asset managers to embrace the coming change of this more granular, more laborious and more detailed data coming in, and to be able to prepare your organization to work with that and to have the right interpretation mechanisms ready to really be as competitive as possible as an impact investor or as an impactful asset manager. So to make sure that we increase this required transition.
So go after the data. We shouldn't have expected otherwise from an accountancy firm, but that's okay. And finally, Paul.
Yeah, a couple of quick points. I think the first, I think the European Union is leading a charge globally on this. One level that can look like a layer of compliance and regulation and bureaucracy, which can be intimidating, but beneath it all, I think there's some fundamental changes to the structured economy, which are radical and are going to, I think, point a direction for the rest of the world. And that creates lots of investment opportunity as well. I think the second point, just on the impact measure reporting side, yes, we need global frameworks and metrics and consistent ways of aggregating, but it's also up to investors and managers to go a level deeper and to really quiz, managers and companies on what their theory of change is, what they're trying to do is different, and to get kind of bespoke and technical as needed to really see if that's happening.
Thank you, and I couldn't agree more. Thanks for your positive take on this torrent of regulation, which I believe really does lead to the change, to the tanker changing course slowly but surely. Thank you so much. This was Paul McMahon from SLM Partners, Luc Olivier from La Financière de l'Échiquier, and Arno Scheepens from EY, formerly known as Ernst & Young. Thank you so much, gentlemen, and we will turn to the next session. Thank you.